talk about the players. Now you'd say, okay, the players in this game are buyer and seller. Clearly, it's 2 of 4. We've got 4 players. We've got the seller, the buyer, the lender, and the investor. The buyer, lender, investor are all kind of on one team, if you will, because the buyer's metrics are going to be representing the lender and the investor's metrics. The seller has slightly different metrics that we're going to be looking at. The seller is concerned about profit, taxes, and time. Am I going to get paid today, or when am I going to get paid? What are the tax implications of me selling like? You know, I want to make money on this. This is my facility. I'm selling it off. How much are you going to pay me? The buyer, we've talked about a value add and downside mitigation. What is the upside? What is the downside? Investors similar in that too, of what is the upside? What is the downside? The main metric that the buyer is going to think about in regards to their investors, cash return on investment. We've syndicated most of the deals that we've done, and sure, we present IRR, internal rate of return, we present an equity multiple, we may present an annual return on investment, but at the end of the day, people want to know, if I give you $1, how many dollars am I getting back? So boiling it down, cash return on investment. The buyer thinking about the lender, lender is more downside mitigated than anybody else. They're looking at yield, risk, and that risk is what we just talked about with the debt service coverage ratio. So we can go ahead and kind of put the lender and the investor off to the side as long as we're thinking about the debt service coverage ratio and cash return on investment. We've got our team covered as long as we're keeping those in mind when we're out there structuring deals. Understanding the seller. There are levers to push and pull with the seller, but making them aware of how we are labeling these levers is helpful. We want to establish what are the terms that we're going to use so that we're speaking the same language. I'm sure you've encountered self-storage facilities where the owner calls them, yeah, these are, this is mini storage, or these are mini garages. In Mexico, they're mini bodegas. That's what they call them. So you just want to make sure that we're speaking the same language, otherwise it's going to get more confusing than it needs to be. So the 4 levers that we have identified to make it as simple as possible when talking with the seller about the infinite numbers of ways that we can get this deal done are money today, money over time, amount of time, and the total amount of money that they're going to receive. Those tend to be the 4 things that they're really concerned about. The one that's kind of missing in there, that exists in this kind of middle shadow, is taxes. But these 4 cover the taxes. That's a byproduct of these 4. Now, what those actually mean is money today is down payment. How much am I coming to the closing table with? Money over time is monthly payments. How much am I paying you each month? Is it principal? Is it interest? The amount of time. What is the term length? If we're doing a conventional closing, I'm going to give you everything today. There is no time. It's today. If we're doing seller financing, though, it's going to be years maybe. Total amount of money is looking at most of these paired up together. What is the down payment plus principal and interest plus the balloon payment, if there is one, all together? What are you walking away with at the end of the day? Now, the buyer, we think we understand it because we're all buyers here, right? We can all be sellers as well. But there's 4 metrics that we're looking at as buyers. And these metrics pertain to the upside and the downside, value add, downside mitigation. Now, these metrics can be kind of divided up according to value add and downside mitigation, but there is overlap. So for value add, we're looking at cash return on investment. That's that upside that we're concerned about. For downside, we already talked about debt service coverage ratio. But dollar per square foot and cap rate are interesting because they're indicative of both the upside and the downside. If I'm buying it today at a 4% cap rate, I need to make sure that I'm able to get that up much higher, especially if I'm not planning on keeping this game of musical chairs going, of doing some sort of creative financing when I sell it. I need to make sure that the cap rate's going to be supportive of whatever the future interest rate is. And I don't have a crystal ball. So I want to be conservative as possible and make sure there's runway there. Now, the dollar per square foot can help indicate if that cap rate's able to move. Because the cap rate, I just know how they're operating, how much money they're making today, those sorts of things. But dollar per square foot, without knowing any sort of what is the opportunity for expansion and lease up and improving their expenses, that sort of thing, it just tells me like, hey, Yeah, it's a 4% cap rate today, but you're buying this at $25 per square foot. I think we're going to be all right in the future here. Also, if I look at these two in the middle, that'll help tell me what sort of metrics I have to be pushing on, what levers with the seller I have to be pushing on. If these dollars per square foot and cap rate aren't exactly what I want to see, time is probably what I'm looking for when I go ahead and negotiate with the seller. I'm going to be trying to get as much time as possible because I can tell you I've only been doing self-storage for about 7 years. I remember a day when people would say, yeah, $50 per square foot, it's a bit high. I could build drive-up, non-temperature controlled self-storage for like $30 a square foot. You're buying it for $50 a square foot? That's a little high. Now, if you get a self-storage facility and it's like $65, $70 per square foot, you're like, okay, all right, this could be good. This could be great. So if I have more time, maybe then things will be better in the future. And we're not going to leave everything up to maybes, but we're narrowing the scope here.